Business owners, they become very profitable and they're doing really well in the business, and you start making seven figures. What's the next thing that you learn about then you can start doing to reduce down your tax liability? That is to invest in real estate. Now, a lot of business owners watch a lot of content online and they're told, hey, buy real estate, do cost segregation, you can write it off. That is not true. Now, a lot of people think that if I'm a real estate professional, I need a real estate license. Nope. You do not need real estate license. This is where a lot of people actually trip. Okay, and they're being lied to. They're saying, hey, do cost segregation. Your spouse can basically be a real estate professional, but you also have to meet material participation. If you are investing in real estate, do it right and do it with a tax strategy. Investing is nice. Doing cost segregation is nice. Generating paper loss, super nice. What's not nice is that when you're told to do all of this without a tax strategy. Hey, Boris Musheyev here. So look, if you want to invest in real estate to save money on taxes, just investing in real estate and doing cost segregation deduction is not going to save you money on taxes, okay? Despite what your accountant or whoever it is that you listen to says, you actually need a tax strategy when you invest in real estate. So in this video, I'm going to break down for you what type of a tax strategy you need, how to actually qualify for these tax strategies using IRS laws themselves, and be able to maximize your deductions when you invest in real estate. So don't listen to all the lies out there. In this video, I'm going to break it down for you. My name is Boris Musheyev. I'm a CPA and a tax strategist. So I release YouTube videos for business owners just like you that are very profitable and now want to use their money to invest in real estate to save money on taxes. So I release tax strategy videos. So if you are new to my channel, please go ahead and subscribe. Say something nice in the comments. I say something nice because sometimes people don't say nice things. So let's play nice and let's get into a tax strategy. So I actually left this board blank on purpose because I'm going to be writing as I'm explaining and teaching you, the business owner, a profitable business owner, right? How to save money on taxes. But I want to bring this example. So a lot of times, business owners, they become very profitable and they're doing really well in the business, and you start making seven figures. What's the next thing that you learn about then you can start doing to reduce down your tax liability? That is to invest in real estate. So you go out and buy a property worth $1 million, okay, purchase price, but after you deduct the land, because the land cannot be depreciated, after you deduct the land, you're left with $800,000. That is the depreciation. So what happens is that if you do cost segregation study, for those of you that don't know what cost segregation is, it is accelerated depreciation that allows you to write off about 25% of the purchase price net of land. So that will produce $200,000 in additional deduction. So if you guys want to learn more about cost segregation, I have a video below in the description section, but let's stay on this video to follow through. This $200,000 that you're going to do cost segregation to accelerate your depreciation and take as a deduction may not be deductible right away for you in the first year if you do not have a tax strategy. And a lot of business owners are told, or they watch a lot of content online and they're told, hey, buy real estate, do cost segregation, you can write it off. That is not true. The reason it is not true, because you have to understand, there's mainly two types of incomes that is on your tax return, right? So business income usually, so I'm doing this for business owners, right? Typically, business owners are the ones that are generating a lot of profit and they want to reduce down their tax liability by investing in real estate. Generally, there's two types of incomes that can be reported on your tax return. There's an ordinary income, which is also your business income. So let's assume this is $1 million, okay? You make $1 million in your business. Then there is a passive income. And let's assume you have 125,000. I don't know why I picked 125,000, okay? But that's passive income, okay? Two types of income. The thing is, there's really no difference between them when it comes to taxation. Both of them get taxed at the same income tax rate, right? We're assuming this is not capital gains, okay? This is passive income. That could be from your real estate, commercial real estate. This could be in the businesses that you have invested and you became a passive partner, which, by the way, if you have a business that you are going to be opening or investing where you have an opportunity to become a passive partner, you should absolutely speak to your tax advisor how to do that, because that will help you accelerate deductions when you start buying real estate. But that's a topic for another day. If you are a profitable business owner, you do not have a tax advisor, get yourself a tax advisor. Otherwise, you will continue overpaying in taxes, okay? But let's come back to this example. So we got ordinary income and passive income, okay? This $125,000, it's passive income and ordinary. They're all both taxed at the same rate. So if you are at 35% tax bracket, guess what? You're going to pay 35% on both, regardless what type of income it is. Now, here's the kicker. Real estate losses, right? In our case, let's say cost segregation gave you $200,000 in losses. Real estate losses are considered passive, okay? Because generally, real estate income is considered a passive income. So all the activities from real estate, if you're not a real estate professional, they're considered passive. So are the losses. So in this case, let's imagine that you actually have or let's assume, imagine. What a creative way of being an accountant. Okay, let's assume you have $125,000 in passive loss right here, okay? This $125,000 now cannot be deducted against $1 million ordinary income. So let's just say that, let's use our number of 200,000 from their example before, right? So you did a cost segregation study, you accelerated depreciation, the $200,000 cannot be deducted against ordinary income. Well, what happens to this $200,000? It just gets carried over, okay? It gets carried over, so I'm gonna put FY, not FU, FY, okay? It's getting carried over to future years, okay? Now you still end up paying taxes on $1 million. So if you did the cost segregation and you paid a lot of money to get it done, and now to find out you cannot deduct it. So let's talk about a strategy when is passive losses, or when are passive losses are actually not passive losses? How can we turn it into not passive losses or actually take it as a deduction? There's 3 scenarios. We're going to talk about the real estate professional, we're going to talk about short-term rentals, and we're going to talk about self-rentals. We're going to cover it all in this video right after this break. Hey, thank you so much for watching my videos so far. I wanted to give you a heads up. I've got this free PDF, 7 tax write-offs that every S corporation business owner must know. The link to this free PDF is down below in the description. So to make sure to download it, that's it. Now let's get back to the video. All right, let's talk about a real estate professional. Okay, by the way, this cost segregation thing, I don't think I mentioned it earlier, because we passed, or the government passed, one big beautiful bill. Bonus depreciation is back, which is why real estate deduction becomes a lot more important, or a lot more bigger, I should say, and investing becomes a lot more important, okay? So investing in real estate, doing cost segregation is a great tax strategy. But like I said before, you need a strategy behind it to be able to actually materialize your deductions and your losses. One of the ways you can do that is becoming a real estate professional, either you or your spouse. Now, this is you, or I'm going to put spouse. Now, here's the thing. You as a business owner are generating $1 million, okay? So you need to actively participate as a real estate professional, but you're not, because you're in business, okay? A real estate professional, you just have to meet the IRS definition. That means more than 50% of your time has to be spent doing real estate, investing in real estate, taking care of your tenants, anything that is real estate invested, okay? I'm not going to get into details of all the to-dos that you have to do, but more than 50% of your time. Additionally, it has to be at least 750 hours. So in our tax advisory firm, when a lot of clients come to us, mainly we have one spouse that runs the business, another spouse does not. So what we say, hey, can this spouse be involved in your real estate? Like, yeah, absolutely. My spouse actually does work in real estate. She takes care of the tenants and so forth. Great. We can qualify that spouse as a real estate professional, because that spouse doesn't have any other job. So for sure, more than 50% of that spouse's time is being met for this rule. Okay. Then that spouse has to do at least 750 hours a week. A year. If I'm not mistaken, it comes out to about 14 hours a week, 14 to 15 hours. Okay. And you are now qualified as a real estate professional. That could become huge for you, because now if you invest in this real estate, this $200,000 can be tax deductible. Why? Because your spouse is a real estate professional. Now, a lot of people think that if I am a real estate professional, I need a real estate license. Nope. You do not need real estate license. You just need to meet the IRS definition of being a real estate professional. Now, you also need what's called 500-hour material participation. So what does that mean? Let's say you own 3 properties right here, right? So let's say your spouse or you together, your spouse is a real estate professional, but now you have to meet material participation. This is where a lot of people actually trip, okay? And they're being lied to. They're saying, hey, do cost segregation. Your spouse can basically be a real estate professional, but you also have to meet material participation. It's not enough that you are a real estate professional, okay? You also need, what is material participation? I keep talking about it. Let's just get to it, right? That means if you combine your hours spent on this property, not you doing real estate overall, but on one property, at least 500 hours. So obviously, if you got a residential home, one residential home, and you're spending 500 hours a year on it, it's probably not a very good profitable venture. And IRS is not stupid, right? So if you got one property, like, yeah, my spouse doesn't work, they do 750 hours looking for properties, driving around, and we only have one property, and they materially participate there, that's probably not gonna fly with the IRS. But if you already have 2 or 3 properties, you can combine the hours spent on each property. So let's say property 1, 300 hours, 100 hours, and 200 hours. Together, that's 600 hours. You can group them, okay? You can group them. IRS allows you to group your activity. Here's the kicker. Here's the best part about it, right? Again, a strategy. What if you, the business owner, did 200 hours here, and the spouse did the other 400 hours? Does that still qualify as material participation? And the answer is yes. Okay, so that is the cool part about this. But you cannot combine both spouses' hours for real estate professional, but you can combine it for material participation. So if you are investing in real estate, do it right and do it with a tax strategy, okay? Because investing is nice, doing cost segregation is nice, generating paper loss, super nice. What's not nice is that when you're told to do all of this without a tax strategy. So real estate professional is a tax strategy number 1. Let's move on to a tax strategy number 2. If for whatever reason your spouse says, you know what, I'm not going driving around looking at properties, I'm not doing any of the real estate stuff. You go ahead, work in the business, buy me all the nice things. I don't want nothing to do with it. I don't care if you want to invest in real estate. You go ahead and do it, and I want nothing to do with it. Then you're like, Boris, what do I do now? I'm stuck with this $200,000 loss that is being carried to the future years, but I want to deduct it. What do I do? And we're going to talk about that right after this break. Hey, thank you so much for watching my YouTube video. Just a quick commercial break. If you like what you see, please like the video. As a matter of fact, share it on your YouTube so that you can help other business owners to save money on taxes. I would also appreciate it very much if you subscribe to my video. If you like, share, or subscribe, it really helps me with YouTube algorithm, where YouTube will really push this video to other business owners and they can learn how to save money on taxes using simple tax strategies that I teach with my whiteboard strategy. Thank you so much, and let's get back to the video. All right, let's talk about another strategy that you can use to write off your paper losses, and that is a short-term rental strategy. So if you meet the IRS definition of a short-term rental strategy, that means your average stay per tenant is 7 days or less. What does that mean? So let's say you've got tenant number 1, 2 days, tenant number 2, 10 days, the average is 6 days. That already meets this test, okay? And you have to actively participate in your short-term rental 100 hours. So that's very easy to meet. There you go. There you go. And that's how you meet that 100-hour test, okay? That is active participation. Then we've got, you have to work there more than another person. So let's say you've got a property manager that manages your entire property, then you'll probably fail this test, okay? So we don't want to fail this test. We want to meet this test at least the first year. Follow me on this. So let's say you have no property manager and you are doing everything. So you are a short-term rental by the IRS definition. So put out the property on Airbnb, VRBO, whatever you want. Now, any losses generated from short-term rental doing cost segregation, okay, are ordinary losses because IRS does not consider short-term rental as passive. Why? Because they're classifying it, quote unquote, this is like you are treating it as a hotel, right? You have an active business. It's an active trade or business. So the income generated from this is ordinary because you're actively participating. It's 7 days or less. You're operating as if you are a hotel, and you're actively participating more than any other person that is also helping you with the property. So IRS says, you know what, this is no longer passive, this is ordinary. Now, short-term rental, this becomes ordinary, and now the $200,000 can be deducted against your $1 million business profit, okay? That's a short-term rental. Now, you might be thinking, Boris, well, I don't want to deal with tenants, Airbnb, and all of those tenants. Cool, that's fine, but there is a still strategy. What if your first year, you treat this property as a short-term rental? You meet all the rules, you put it out on Airbnb, you do not rent it for more than 7 days, you actually actively participate in it, make money, rent it out to tenants on Airbnb, do all of that stuff your first year, do cost segregation, generate the $200,000, get your deduction. The second year, you know what? I don't want to be actively participating in this anymore. I want to focus more on my business. Great, you can turn this back into a passive activity, which is the regular rental. But remember, in the first year, you participated, you met all the rules, you worked, it was treated as a hotel. The losses that are generated are ordinary losses and can be deducted because now you've done this beautiful thing that's called cost segregation, 100% depreciation from one big, beautiful bill. All right. That is that strategy. Now let's talk let's talk about another strategy. I love this, right? This is amazing. Now this is for those businesses that actually own their own commercial building in which their business is situated, right? So there's two ways you can have a property for your business. So let's say you have an S corporation, okay? So you've got an S corporation, okay, that owns your business, right? So I'm just gonna, well, it does own the business. I'm just gonna write business activity, right? So you've got business activity and the S corporation buys real estate. So I normally never recommend, and if you're working with a proper tax advisor and an accountant, they should tell you that you should not be buying any real estate in an S corporation. There's sometimes you may need to do this for a completely different reason, but honestly, you do not want to have a real estate in an S corporation. So what a lot of my clients do, and what I recommend to them instead, is that when we have an S corporation and you want to buy a building for your business, just put it into an LLC. I'm going to put it a triangle. This is an LLC, okay? Now, this between S Corp and LLC, right? S Corporation will pay rent to your building. Now there is a relationship, okay? Now what happens is that they become, on the IRS rules and under IRS eyes, this becomes one activity, okay? I kid you not. This is all in the IRS tax code, right? IRS says if you are renting your own building to your business, you become one activity. Any losses generated from doing cost segregation can be deducted against your S corporation, but you have to meet what's called an economic test. Now, what is economic test? This is really important, by the way. Business owners that you are watching, that means either you or your spouse have to own the business 100%, and you or your spouse have to own your rental property 100%. Did I say 1% here? I don't remember what I said. 100% and 100%. Now, if it's you and your partner owns this and you and your partner owns this, you still meet the test. Now, you also have to be your own tenant 100%. If you're not your own tenant 100%, let's say there is 50% you and 50% another tenant, and you do meet economic test, then only 50% of losses generated in the LLC, so let's say doing cost segregation, can be deducted against your S corporation profit. In most cases, my clients that we work with, they're like, all right, now I understand this scenario. Maybe I'd rather invest in a building. I have an opportunity to invest where I am the only tenant, so I can do this. And actually, we have few clients right now using this strategy, and we are doing exactly this for them, okay? So this is another strategy. So when you combine this, there is no passive losses generated from this building. Why? Because we're combining it. And by the way, if your accountant does not know this, and if you have this situation, you should let them know, hey, do this for me, and attach a statement to the tax return, letting the IRS know that we're combining, grouping, in other words, both activities. So these are the three real estate tax strategies that you can use. Obviously, if you're doing the cost segregation, investing a lot more in a lot more buildings, you don't want to deal with the short-term rental. You don't have the self-rental. The real estate professional qualifying your spouse is the biggest play for you, especially doing the material participation. Again, if you've got one property, okay, if you have only one property, you did the cost segregation, and you're like, hey, I've got this residential property, 2-bedroom home, and I want to do the cost segregation. My spouse is going to be a real estate professional. It's probably not going to pass the IRS smell test, all right? So be careful who do you work with. Be careful how you do this. I love the fact that you would want to invest in real estate. That is a solid strategy, right? I mean, that is a solid play, I should say, but you need a tax strategy behind this. And hopefully this video was helpful. And if you like this video and you watched it this far, please subscribe. Let your other friends know, share this video, leave me a comment below. Let me know if this was helpful. Thank you so much, and until the next time.